Welcome to Ironton Capital. Today, you're going to discover how private equity companies like Ironton Capital go to work for you so your portfolio can grow on autopilot while you enjoy doing what you want to do. It's time spent with family, vacations, volunteering for your favorite charity, rather than taking on another part time job managing investments. In fact, let me ask you, have you ever wondered what it would be like to wake up in the morning with all the time to do what you want to do rather than what you need to do because your investments are making returns on autopilot? Would you like me to share how you can get more diversified within your portfolio or self-directed IRA with less work? Well, that's what you've been asking for, and guess what? That's exactly what we have for you today. So I promise that by the end of our time together here today, you'll know everything about private equity so you can work smarter, not harder. Sounds good, right? And I have to share a usual love letter from our attorney. Ironton Capital is not a financial or an investment advisor. We do not promise or guarantee any income or particular result from your use of the information. Your use of the information contained herein is at your own risk. Now, who am I and why should you listen to us, right? If you haven't been following us for a while, here is a mercifully short introduction. Lon Welsh is our founding and managing partner. He's just a powerhouse. After 8 years in strategy consulting with Deloitte and Accenture, he moved into commercial real estate transaction and development, generating over 20% IRR over the last 20 years of his investing career. He's also the founder and CEO of the largest independent Colorado brokerage, Your Castle Real Estate, with 750 agents, 5,200 annual deals, and 2.8 billion in annual sales. He founded First Alliance Title before exiting to Compass, with just a wealth of experience in the industry. He also loves giving back, including serving our board of directors for Denver Zoo, Boys and Girls Clubs in Denver, and the Denver Aurora Ronald McDonald Houses. Meet our CEO, Brent Geyer, with over 25 years of experience in real estate acquisition, development, land use, investment, and property management covering multiple states, and a historical focus in both urban and resort real estate markets. Brent has successfully completed well over $1 billion in transactions and consistently applies that depth of experience in evaluating Ironton's investments. He's one of our secret weapons. Richard Landry is just a wizard of portfolio management, having been personally responsible for more than $3 billion, including equities, real estate, debt and credit products for hedge funds, private equity funds, in both public and private companies. Ironton engaged Richard to help with investment procurement and research, and he's naturally assumed the leading roles in these efforts with fantastic results. Together, the investment team brings a wealth of experience working in investment real estate. And after all of our ups and downs, do you know what we found? The fastest and most predictable path to financial security and growth is passive investing. If you can put your investments on autopilot, then you're on the way. You're on the way to just where you want to be, true freedom, especially if you can do that in a short amount of time. So our ultimate mission here today is to help you do that quickly and consistently. And because knowledge is power to do just that, I'm going to dive in right now. Would that be okay? Great, because there are challenges. There's a lot of information out there, and it's hard to sort through it all. So you educated yourself as much as you can and acquired assets, and they're eating up more and more of your time. Until you've got another full-time job and are trying to hold out long enough that you hit a tipping point and can retire, and it's getting harder and harder because you don't have a simple, proven process. Because you didn't have all the pieces, and now that you do, you'll learn that when you leave the heavy lifting to the experts, you'll immediately notice how much happier you are and how much easier building a legacy can become. So during our time together today, you're going to have the opportunity to see the world of investing through our experienced eyes. You're going to see how this system has changed our whole take on how we went from active to passive investing. Does that sound good? Great. Let's dive in then. So what's different about private equity investing? Imagine and picture a simple avenue of investing for accredited investors that allows you access to multiple high-grade investments without having to manage contractors or dealing with tenants. A simple, proven avenue that is the backbone of your entire portfolio. So hopefully you have a pen and paper handy because we're going to dive right in. And we're going to show you exactly how private equity works and the exact numbers that we are looking at that makes us so excited to get moving. Ready to go? Let's do it. Now, I know that you've been doing well in your profession and likely investing too, because that's who finds us. Some of these concepts you will recognize, so you know what we are about to say is true. You have likely struggled with some of these terms in the past because the world of finance can overcomplicate definitions. That makes sense? And while investing can be complicated, you'll see that this time it can be simple because you are ready, because our system makes it easy, and because this time you have help. So, how does a busy individual like yourself find 8 or more different investments for your passive portfolio? That's exactly why we founded Ironton Capital, and it all starts with syndication. A real estate syndication is when a group of people pull their money together to invest in a real estate project. It's like teamwork, each person contributes money, and together they buy properties such as apartment buildings, shopping centers, or even an office building. One benefit is that it allows investors to invest in large properties or projects that they might not be able to afford on their own. It also spreads out the risks because if one property doesn't do well, the losses, as well as the wins, are shared among all the investors. Additionally, real estate syndications often provide passive income through rental payments or property appreciation. Now, there can also be some drawbacks. There are often just 1 or 2 properties, which doesn't bring much diversification to balance risk. Investors usually have limited control over the property and its management decisions, since those are typically handled by a designated manager or sponsor. This is usually a drawback, however, for private equity funds too, as you'll see in a moment. Investments will usually be highly illiquid, meaning it can be challenging to sell your share of the property if you need to access your money quickly. This applies to private equity investments. So this applies to private equity too. Like any investment, there are risks involved, such as fluctuations in the real estate market or unexpected expenses. So before the SEC enabled private equity funds to be more broadly available about a decade ago, syndications were the primary method by which investors got access to passive real estate projects. Is that making sense? So what is a private equity fund? It is a type of investment that collects money from investors to buy and manage properties. It's also like a big pool of money that's used to purchase multiple real estate assets, such as apartment buildings, office spaces, and shopping centers. The private equity fund can purchase the properties directly, or the fund can invest in sponsors who are directly hands-on with the real estate. The fund is managed by a team of professionals who make decisions about which properties to buy, how to improve them, and when to sell them for a profit. So what are the advantages? It allows passive investors like you to invest in real estate without having to buy and manage properties themselves. It provides diversification because the private equity fund may invest in a variety of properties across different locations and sectors, spreading out the risk. Ironton's national diversified funds, for example, will have 30 to 40 properties in a fund. Investors can also benefit from professional management expertise and potentially higher returns than they might achieve on their own. Like a syndication, investors typically have limited control over the fund's investment decisions as they are made by the fund manager, and real estate private equity funds often require a significant initial investment and have longer investment time horizons, meaning your money might be tied up for several years. Are you getting this? Great. Like any investment, there are risks involved, such as market fluctuations, economic downturns, and the potential for losses. And remember, it is essential for investors to carefully consider their risk tolerance and investment goals before participating in a real estate private equity fund or any investment. Always talk to your financial advisors before making any decisions to invest. So how does a private equity fund work? Everyone knows that working with an expert makes things easier, right? There are several parties involved in this form of investment to make it go smoothly. Let's explore everybody's role. There's the limited partner, or LP. An LP is the individual investor like yourself. Here are the common tasks for the LP. You choose your private equity fund with your financial advisors. You decide the investment size. You read quarterly reports. You get to reinvest or deposit your returns. And you really enjoy passive financial freedom. Next comes the general partner, or GP, the private equity fund manager, much like Ironton Capital. Here are the common tasks for the GP. We monitor national and local trends. We network to identify opportunities. Often the best deals are off market and are found via networking. We review multiple projects. We select optimal investments. We negotiate favorable deals and perform extensive due diligence, including checking the sponsor reputation and track record, financial, operational, and additional aspects. We perform site visits and we perform detailed financial modeling, and we maintain regulatory compliance, which includes maintaining accounting records, coordinating taxes, and researching tax optimizing strategies. Plus, we do the quarterly reporting to all of our limited partners. Finally, the sponsors provide property management for the investment. So they select the physical project, they arrange and guarantee the financing, they rezone the property if needed, they arrange construction and engineering permits, they oversee construction or renovation, and they manage the property, which includes finding and managing the tenants, maintaining the property, and managing the legalities of the project. In fact, when you invest in a private equity fund, it is like investing in a mutual fund with an active manager that researches the economy and picks individual stocks to match the investor's investment strategy. The private equity fund adds a layer of expense in exchange for professional experience and expertise. The private equity fund then picks individual sponsors that are hands-on with the real estate investments. If you like to research and pick out your own stocks without a mutual fund, that would be like skipping the private equity fund layer and investing directly in the real estate sponsor. That legal form is called a syndication that we described earlier. There's less expense for the passive investor, but a whole lot more work. So what's best? Really depends on what you enjoy, what your skills are, and what is the next best use of your time. Making sense? So what do private equity fees and expenses look like? Real estate private equity funds typically charge fees to cover those management and operational expenses that they are taking care of for you. These fees can vary depending on the fund structure and the investment strategy, but commonly include acquisition fees. So some real estate private equity funds charge fees for identifying and acquiring properties. These fees may vary based on the size and complexity of the transaction. Management fees. These fees are charged annually and are typically a percentage of the total assets under management, which usually range from about 1% to 3%. They also cover the costs of the fund management, including salaries, office expenses, and administrative costs, to list a few. Then there are performance fees, also known as carried interest or carry for short. Performance fees are typically a percentage of the profits earned by the fund, often around 20%. These fees are charged only if the fund achieves certain performance benchmarks, such as surpassing a specified rate of return or reaching a certain performance threshold. Performance fees incentivize the fund manager to achieve strong investment results. Usually the investor gets paid first with what's called a preferred return. So some other fees that may be included, additional fees like I include expenses such as legal fees, due diligence costs, and the fund administration fees. It's important for investors to carefully review the fee structure of a real estate private equity fund before investing and to understand how these fees may impact their overall returns, and go over these with your financial advisors prior to investing. Are you getting this? I'll show you how a real world case study of how this fees work and answer your questions in a moment. Now keep in mind that there are 4 offsets to these private equity fund expenses. When a private equity fund makes a large investment in a sponsor, the fund can usually negotiate better terms than a small passive investor could. This is what's called a side letter. These savings are usually not enough to offset all of the PE fees, but it may offset a meaningful portion of them. Most sponsors would prefer to work with a smaller number of large investors, such as private equity firms like us, and not hundreds of smaller retail passive investors. As a result, the larger investors see many more of the best opportunities than the smaller passive investors would. For a given amount of investment risk, these off-market opportunities often have better returns than the typical deals in the passive investment market. This is where the PE funds earn their fees, gaining you access to the table. Additionally, most sponsors have a friends and family list. When they have a small deal with great economics, it is never broadly circulated. The inner group of friends sees it and fulfills the investment need. Outsiders are only brought in when the inner group doesn't raise sufficient capital. Established private equity firms often have access to these deals. We see several of these a year that never actually make it outside a small circle, and they often have very favorable terms. Finally, there are short-term opportunities where a sponsor needs to raise cash rapidly for an unusually good opportunity. These investors that the sponsor has found to be reliable in the past are quick to decide and deliver funds get called first. And then the attractive return on these special situations usually ensures only a small number of large investors are needed before the funding is raised. The private equity firms spend a lot of time networking to establish the relationships to get access to these investments. Making sense? Case study time. So here's what our summary of projected returns and fees typically look like for our investors. To walk you through real world numbers to see how this works, I'm going to walk you through here step by step. So typically, we offer a targeted net return of 16 to 20% IRR, and that's annualized and compounding and net of fees. If I can direct your eyes directly beneath that, our national diversified funds typically go on about a 4 to 6 year time horizon. And the way you get paid is through a preferred return, and then following the preferred return is the waterfall structure beneath that. So if you're a Class A investor, we're going to pay you an 8% annual non-compounding preferred return. If you're a Class B investor, you're going to get a 5% annual non-compounding return. Now, the difference from the A and B is the depreciation. So the reason the A class gets a higher pref is because they're not getting any depreciation allocation, whereas the Class B shares are getting all of the depreciation or passive loss allocation. So that's the key difference there. One important thing to note on the pref is that if cash generated during the project, such as in year 1 or 2, is not sufficient, the preferred return accrues to the next year and is paid in future periods or at the sale or refinance of the property. There is no incentive to the general partner until all the preferred is up to date. So once we pay the pref, and if the project does better than, let's say it does better than 8% for the Class A shares, once the pref is paid, the next step in the waterfall is a profit sharing component where up to 20% IRR, so from 8 to 20%, you, the limited partner, will receive 72% of the profit. Ironton Capital or the general partner will receive 28%. And then next, from 20 to 30% IRR. So if we do better than 20, we then split the profits from 20 to 30% at a 70-30 ratio in favor of the limited partner. And if we do better than 30%, then from 30% onward, the LP will still get paid a higher percentage, but the division of profit will go from 60% to the limited partner and 40% to the general partner. And yes, the GPs invest in each of the funds, typically about 2 to 5% of the overall equity. Now, there's 2 fees here. There's a one-time acquisition fee in the first year. That's a flat fee of $75,000, which is divided pro rata among all the LPs. And this is based on a $7.5 million national diversified fund. And then every year there's an annual management fee. This is a flat fee of $150,000, and that is divided pro rata among all the LPs as well. If there's any expenses that arise, such as audit, tax, and fund administration by third parties, that's estimated to cost about $40,000 to $50,000 per year. And so if we have 90 investors in the fund, the max is about 99. But if we have 90 investors in the fund, that equates to about $560 per investor. Does that make sense? So many of our investors are busy professionals or small to large business owners who have enough on their plate, but want to take advantage of commercial real estate investing, increase diversification, and in the case of our income funds, higher returns than money market or CDs. Our founder, Lon Welsh, was in that place himself and founded Ironton to give his friends, family, and associates access without all the work. And later, he expanded to help more busy professionals, such as yourself, put their money to work passively. Like Tom, who explains that determining where to invest can be incredibly challenging in this environment. Lon has a freakish ability to understand and analyze real estate deals and know where and when to direct funds for maximum gain. Or even like Jesse, who after working with us for years has seen that we invest with proven methodology and a very unique approach based on historical analysis and proven modeling techniques. And of course, Justin, who was able to transition his hard work as a small business owner into a passive portfolio. So now imagine and picture this. You finally are able to get your time back, time to relax and enjoy quality time with the people who matter while your portfolio continues to grow. I want that for you too. So let me ask you, did we provide value for you today? Did you get some insight into what you might be missing when you thought passive investing was out of your reach? Would you like to learn more? Because every investor is not the same. From long-term growth to short and medium-term liquidity, at Ironton Capital, we have funds to fit many portfolios, mostly real estate, but some that are completely uncorrelated from real estate or the stock market. Before I give you this opportunity, let me show you the features and benefits joining Ironton will give you. Rapid results, because we do all the finding, touring, and due diligence for you. And since you have more time to do what you want, when you want, with the people that matter, enjoying greater diversification across geography, asset class, strategy, and sponsors. And this investment is entirely and truly passive. So we do all the heavy lifting, provide quarterly updates, and you deposit the gains. Is that making sense? Are you getting this? If I did a good job, would it be okay if I share with you how we can go deeper on this topic? So who is this not for? This is not for people who want to do it the long and hard way. This is not for people who jump in with their eyes closed. I want you to know exactly what is included, and you must check with your financial advisor to make sure we are a good fit for your portfolio planning, of course. So who is this for? This is for accredited investors who are done dealing with renters or looking at endless deals and are ready to leave the heavy lifting to the experts. Now, this investment is for accredited investors only, and you must meet one of these criteria. Single household income over $200,000 or more in 2 or more recent years. Dual household income over $300,000 in 2 or more recent years. And investable assets over $1,000, excluding your primary residence. So you just have to meet one of those criteria, not all three. So we have several options for our accredited investors. And remember, we're here to answer all of your questions. So if any come up, please put them in the chat. And as they come up, we'll make sure we get them all answered. So here's an overview of Ironton Capital's funds that we have available. Going from left to right, we have our National Diversified Fund. Currently, we have NDF 10 open. When we launched Ironton Capital in 2022, we started with NDF 5. So we primarily invest in real estate through the National Diversified Funds. You'll get anywhere from 10 to 15 investments in each fund, and we'll typically raise between 10 to 20 million. We're targeting a net of fees of 16 to 20% annualized returns, and your capital will be locked up for about 4 to 6 years. So any liquidity that comes from the National Diversified Funds will come as we sell properties, or perhaps we refinance those properties and keep them for cash flow. But either way, it's a little bit more unpredictable, but it is also a very tax efficient vehicle. So everything would be taxed at about a long-term capital gain tax rate. There's an additional tax advantage, like I highlighted earlier, where if you're a Class B investor, we'll be able to offer you more depreciation than you otherwise would get. Often we have a lot of investors that will sell their rental properties and they'll invest in our National Diversified Fund, the Class B share, to capture some of that depreciation to help offset the gains in their rental properties that they sold. We like to look for a minimum of a $50,000 investment across the board for all of these funds. Now, if cash flow is your priority, so perhaps you're an investor that maybe you just sold a bunch of rental properties and you need to replace that cash flow, or maybe you're in retirement or near retirement and you're looking for some extra income to live on, the short and medium-term income funds are great options for you. So the short-term income fund is primarily invested in a hard money loan portfolio where we're underwriting, originating, and lending out loans to borrowers who are engaging in fix and flip projects or perhaps larger commercial scale properties. This fund returns about 8 to 9%, though lately we've been hitting around an 8.5 to 9.5% return range. It offers quarterly dividends. And what's great about the short-term income fund is we're able to offer you high liquidity. So if you invest and you need to get your money back for whatever reason, you only have to give us a 30-day notice and we can give all or portion of your capital back. We invest in a fund size of about 200 plus million. There's about 200 to 400 individual investments. So as of our latest update on the short-term income fund, we had about 238 active loans within the portfolio, and your capital is diversified across every single one of those loans in the portfolio. There's also some tax advantage with the short-term income fund. So the hard money loan allocation of the short-term income fund has obtained REIT designation status, which means that it will be taxed at, for most people, the federal 20% capital gain tax rate. So not ordinary income, but taxed as a REIT. And again, here the minimum investment is $50,000. To the right of that, we got our medium-term income fund. So this is the fund that is completely uncorrelated to the stock market or any interest rate volatility. It's of course uncorrelated to the real estate and stock market, and we're able to offer much higher returns for this fund of 11 to 13% fixed, and that is based on the assets under management with Ironton Capital. So the middle of that is about 12%. So if you have $500,000 to $999,000 invested across all of Ironton Capital, you'll make 12% on that money, or you'll get about a 3% check every quarter. It's a $100 million plus fund size. Your investment is diversified across 25,000 individual medical receivable invoices across multiple states, multiple physician clinics, and hospitals. There's no tax advantage, unfortunately, on this thing. So whatever your ordinary income tax rate is, that's what you'll be taxed at as well. This is probably one of our more popular funds just due to the fixed and predictable income. And it's been a great option for those investors that are divesting out of their rental portfolio and looking to make their life a bit more easier. This is a great option for them because we often find that we're able to get even better cash flow for the medium-term income fund than they were getting on their rental properties that they sold prior. And then every so often we have a single asset fund, mostly real estate. Oftentimes they're local Denver projects. For example, we invested in a new 10-unit townhome project in the West Colfax Sloan's Lake neighborhood. We raised about $1.5 million for that project. That's typically what you might find in a single asset fund. We also did a 34-unit value-add apartment complex project up in Westminster. We've gotten a couple offers on that project, and we were able to finish that one pretty quickly and get it listed. So every so often we have that. We target about the same returns in those projects as we do the national diversified funds. Likely the timeline is much shorter. So rather than a 4 to 6 year timeline, it might range anywhere from about 1 to 3 years, though I have 5-year as the max end of the range here. Liquidity varies, but it will typically be locked up for the duration of the project until it's sold or refinanced, or if there's any quarterly cash flow to arise from the rental income. And you can see our track record over our past 23 funds. I won't go into a lot of detail, but you will have this slide deck as a download in your inbox immediately following this event, so you can go over with your family and advisors. So as you'll see, National Diversified Fund 1, which launched in 2019 and 2020, we're still within the on the lower end of the range on the IRR, but we have sold 5 of the 8 investments. We had one office building bought in 2019 where it ended up being a total equity loss, but then we had a build-to-rent project in McKinney, Texas that achieved a 58% IRR. So that's what's really important about diversification here is you might have one project that doesn't pan out so well, and for that, and you're not 100% exposed to that one project. So it's really important that you understand that and why diversification is so critical here. As we'll typically have between 10 to 15 investments in each of these national diversified funds, we expect that one might not pan out to be what we expected. We might have one home run, and then we might have a lot of singles, doubles, maybe even some triples thrown in the mix too. So keep in mind that there are many ways to fund investments that you may not have considered. So here's what many of our investors have done: cash, self-directed IRA, or if you're retired, a self-directed 401k. You can take cash out with a line of credit on a 1031 property before sales. And in fact, we can run an analysis for you to see if you would do better doing a 1031 exchange or going passive. We've also had investors tap into the equity in their rental properties or their primary residence, so you can get a HELOC and invest some of that cash. I've personally done that myself. And some unlock their equity to put it to work for them with a second mortgage line of credit on an investment property like what I just mentioned. It has a lot of debt equity. And again, we're happy to jump on the phone with you and run an analysis for you so you can consult with your financial advisor to see which is best for you. And we are truly invested in making this world a better place with you. This is really important. So our general partners have donated over 250,000 to these charities in the past 5 years, and we are excited to give more as you and I succeed together. We plan to donate at least 10% of our profits, either to local charities or nonprofits chosen by our limited partners. Now, because investing is individual to each person, we've set aside some time for you and would love to hop on the phone with you and answer all of your questions. Please use this direct link to book a 15-minute call with our investor relations team, and you can share your investing goals and see if Ironton Capital is a great fit for your goals. Because it's not just about returns, but the time you've also invested in making those returns. If you have current rentals or are wondering if you can make as much or more investing passively, we'll run an analysis for you to share with your advisors. Same for your IRA and your 401k. We can analyze your current returns versus our projected returns for you. We're here to help make that an easier process for you, but our time is limited, so go ahead and book now. So thank you for being here and investing your time with us. We're here for you, so let us know if we can help, and here's to your success.